Yesterday, we did see the markets pick up pretty handily. You think right now, though, the markets are on a little bit of a high and that there is a downturn that's coming when it comes to the U.S.?
Well, I think if you look at earnings and what they've been able to deliver last year and then the revisions that we've seen this year downwards, that's really my concern, is that, in essence, the market was a bit on a sugar high in the first couple of weeks of this year. We've seen some revision earlier, I should say late last week, and then maybe a bit of a bounce. But ultimately, earnings expectations for this year are now around 4%, right? They were at 8% when we started the year. They've come all the way down to 4%. And I think that's something to keep an eye on, right?
Did you think the December lows were a better place for this market, or did you think that was overdone?
No, ultimately, you just have to look at valuation. And right now, it's not at a place where it's worrisome. You know, it's not at super elevated levels, but at the same time, it's not cheap. So you're left with what are earnings going to deliver? And if earnings are expected to deliver 4% this year, there's just not as much enthusiasm like last year when we were looking at double-digit earnings growth.
Sure. We do have a little bit of a bear-bull debate today. And Brian, you're going to play the part of the bull on this because you think that we could be poised for higher ground from here.
I do believe that. I mean, I believe we're in a secular bull market, and I believe that valuations are fairly reasonable and that we're starting to see some of the policy uncertainty that's been weighing on the market and causing volatility in 2018 potentially abate.
You mean the trade deal?
Well, first we saw it with the Fed. The Fed was key, right? The Fed backing off. We should get greater clarity on trade and perhaps even Brexit. The most important thing on all of it is, as long as the U.S. currency, the dollar, stays relatively stable or even weakens some in here, there's very little reason to expect conditions to tighten anywhere in the world, and valuations are still generally reasonable.
Andres, how much of this is just that you like some of the emerging markets better, just like Morgan Stanley?
Yeah, I was just going to basically mention that, which is a relative call. Right? In essence, it's not that I'm expecting U.S. equities to do significantly worse. It's just that emerging markets have a valuation tailwind and a currency tailwind, right? So, for instance, if the dollar sees a bear market, which, by the way, we just had a 7-year bull run, you both get valuations that are 53% discount to the U.S., and you get a currency tailwind as well.
I agree with that completely. I mean, typically, the dollar cycles end at the end of the Fed tightening cycle, so we could debate whether we're there, but we're probably pretty close. And if you think about what last year was all about, last year was about the U.S. growing above trend and China growing slightly below trend. And what this year is about is the U.S. slowing back towards trend and China doing everything they can to stabilize growth. So from this year's perspective, we're right to see emerging markets outperform. Over the next 5 years, again, EM valuations, where the currencies are, you would expect to see modest outperformance compared to the United States.
Andres, where in the emerging markets do you think are some of the best possible places to put your money right now?
So, I mean, when you look at valuations within emerging markets, may I dare say China is actually one of the places that looks appealing, right? Not in the short term, but if you think of the biggest driver of expected returns is valuation outside of earnings, China is close to 1/3 of the MSCI index, right? So that when you're making a call on EM, you have to believe that China is going to be part of that.
The stimulus that they've been putting into place is probably not going to kick in full force for a little while yet.
That's absolutely right. So let's put it this way. There's short-term catalysts, and then there is, in essence, over the next 10 years, how things will play out. And I think China has been going through this big transition from exports driving basically growth to now having domestic consumption being the growth engine. And they've been going through that transition for years. I think in the next 10 years, we're actually going to finally start to see, the over 1 billion people in China actually driving that growth.
Hey, Brian, just to Andres's point about what happens with the earnings recession, if we're looking at earnings just even flat, let's say, what does that mean? The valuations here already reflect that?
Yeah, I mean, I think you would probably see multiples expand in this environment to drive markets forward. I mean, we're still in a very low interest rate world. We're in a benign inflation world. There's very little to suggest that this cycle is going to end. I mean, this economy is going to grow modestly, and policymakers are going to be on the sidelines. So investors are likely to pay up for growth wherever they can find it. And that's going to be in a lot of good U.S. growth companies. It's going to be parts around the world where valuations are more reasonable.
Andres, do you disagree with any of that?
No, look, as I said, I think the U.S. equity call, it's more, do you actually think that earnings will deliver what they're going to deliver? And if they do, and actually we've seen cases where earnings revisions have gone down and the market goes up, right? I can't, I have no predictive power of what's going to occur there. For me, it's more around what relative looks more appealing. And from that perspective, emerging markets look more appealing from a valuation standpoint.
All right.